China's economy has a puzzle. Its factories are booming, exports are hitting record highs, and its AI industry is growing rapidly. Yet, the economy just delivered one of its weakest quarterly growth numbers in recent years. So, what's going on? If China is producing more, exporting more, and investing heavily in AI, why is economic growth slowing? The answer lies far beyond one GDP number. China's economy grew 4.3% year-on-year in the second quarter, below economists' expectation and slower than the 5% recorded in the first quarter. While China's National Bureau of Statistics said the economy remains within a reasonable range, it also acknowledged growing external uncertainties and a persistent imbalance between supply and demand. The economy has split into two. Here's the contradiction. China's factories are still performing well. Industrial production rose 5.3%. Retail sales returned to growth after contracting in May. Exports also remain strong, driven by demand for electronics and AI-related products. But another part of the economy is struggling. Businesses and local governments are investing less and domestic demand remains weak. In simple terms, China is producing more than its own economy is consuming. The property crisis still hurts. A big reason for that weakness is real estate. For years, property was one of China's biggest growth engines. But after the sector's crisis began in 2021, home sales and prices have remained under pressure, hurting household wealth, consumer confidence, and investment. Many economists now expect policymakers to announce fresh support measures at the Communist Party's Politburo meeting later this month. Artificial intelligence is undoubtedly becoming one of China's biggest strengths, but economists say AI alone cannot offset deeper structural challenges. China's population is aging, the working age population is shrinking, and debt levels remain elevated. These long-term pressures continue to weigh on investment and domestic demand. In other words, AI can improve productivity, but it cannot on its own revive the broader economy. For now, China is not facing an economic collapse. Its manufacturing sector remains competitive, exports are resilient, and AI continues to attract investment. But the latest GDP data suggests those strengths are not enough to offset weak domestic demand, slowing investment, and a prolonged property downturn. That's why investors will be watching the Politburo meeting closely. Because the real question is no longer whether China can manufacture more. It's whether it can restart the parts of its economy that have stopped growing. Follow Business Standard for more such stories.